All right, let's take a look at another question, a little bit long and drawn out, so we'll have to kind of scroll through the screen. So let's see what it says here. It says multiple product planning with taxes. Now, I was not aware of this being a multiple product question, so I don't think that's going to come into play. But we are going to have to deal with taxes and put together another contribution margin income statement based on some changing facts as we go through here. So we have, let's see here now, we've got requirements A, B, C, and D. Okay, so we will have to kind of move around. You'll have to stop the video to kind of jot some notes as you go. And so let's see what we've got here. It says, determine the annual break-even point in sales dollars. Okay, so you can probably do this on your own, but we said earlier that our formula for determining break-even point in sales dollars is simply our fixed cost divided by our contribution margin ratio. So if we look here at our original contribution income statement, looks like we have total fixed costs, both product and operating or period fixed costs of $266,000 in total. Okay, so we're definitely going to need that. So if we were going to set up a fraction, this $266,000 here, forget about the parentheses. Just we would plot this 266 as our numerator, and then we can probably do this in our head. But they've given us contribution margin here. And so that is just a percentage of sales. And our contribution margin is, let's see here, what did I do? I goofed up, didn't I? It's $380,000, and we would simply divide that by sales of $1 million. Probably figured out just by looking at it that our percentage, our contribution margin ratio is 0.38. So I'm going to keep that number in mind. I'm going to take this 266,000 and I'm going to divide by 0.38. And if I do that, come up with 700,000. Don't you like it when that happens? It's almost always right whenever it comes out to a number like that. It's almost like magic, you know? All right, get rid of that because I want us to do something else. Determine the annual margin of safety in dollars. So if we have a situation where we're provided with sales dollars, all we have to do to get that is take that amount, that $1 million, and subtract from it our answer that we calculated right here of 700,000. So that's pretty easy. Okay, so we got that, so we probably don't need that anymore. We will put it back on there. So it says, what is the break-even point in sales dollars if management makes a decision that increases fixed costs by $76,000? All right, well, let's go back up here. We haven't done anything here to alter the variable cost percentage. We're only increasing fixed costs. So the contribution margin ratio should remain at 38%. So our fixed costs before were $266,000. So let's go ahead and put that figure back on the calculator. And now all we're doing is maybe we've had an advertising campaign, something like that. We're just increasing it by 76 grand. Okay, that gives us a new fixed cost amount of $342,000. We're going to divide that by 0.38. 0.38, and we come up with 900,000. Okay. So what you need to be recognizing there is, I mean, I don't want to, you know, it seems obvious to me, but if we increase our fixed costs, our break-even point is going to go up. You know, the only way that would not happen would be if we increased our fixed costs and were able to increase our selling price or greatly reduce our variable cost component. We don't have any information about that in this particular question. So we'll go with the 900,000. And then let's see, let me move this calculator a little bit out of the way. It says with the current cost structure, including fixed cost of 266. So we're not considering the 76,000 extra here, just the 266. It says what dollar sales volume is required to provide an after-tax net income of $250,000. Also notice this could be very important. It says do not round until your final answer, and then round up your final answer to the nearest dollar. Round your answer up to the nearest dollar. So these little details like this are incredibly important, because if we round too soon, too late, round in the wrong direction, we could end up being off by $1, and if we don't know what we're doing, we don't necessarily understand that we're only off by $1. We might, in our minds, we just did it wrong, and then we're beating our head against the wall. And when you beat your head against the wall, that tends to, hurt. So we're trying to, if we can, we kind of want to try to avoid doing that. So how do we figure this out? All right. Well, let's see here now. They're talking about taxes. And in part D here, they don't have any information about that. But if you'll notice right up here in our contribution income statement, we have income taxes of 37%. So kind of high. So we're going to plot this $250,000. Okay. And we're going to divide that $250,000 by not 37%, but 1 minus 0.37 or 63%. Okay. So it's 1 minus the income tax rate. In our example, it's 37%. So subtract 0.37, that's 0.63. So we're going to divide that by 0.63. Okay. And that gives us a big old number. Let's see what we can do here to maybe make this where we can see it. Okay. So we've got 396,825. Blah, blah, blah. And notice it says do not round until your final answer. So what we're going to do is we are going to add to this figure our fixed costs of 266,000. Okay. And that's going to give us 622,825. Blah, blah, blah. All right. Recall that our contribution margin was 38%. Okay. So now we have our $250,000, what they call it, I think they were calling it desired after-tax income of $250,000 multiplied by 0.63, and then we added to that these fixed costs of $266,000. Now what we're going to do is we're going to divide this figure by that contribution margin that we've already calculated of 38%. Okay, so divided by 0.38, and that's going to give us 1744, $277 and 36 cents. Now, I believe that it said to round up to the nearest dollar. Be advised that they may not mean it. I think when they say round up to the nearest dollar, well, I'm not sure that that's what they mean. So let's see here. What was that figure again? I've already forgotten it. 1744277. 1744277. And then they said to go up. Okay, so we can do that. And let's see here now. Okay, I paused the video and I worked ahead and found out that they did not want us to round up. They wanted us to round to the nearest dollar. Okay, so before we keep going, I'm going to correct that right now. I also know that these answers up here are all going to end up being correct. All right, so it says prepare an abbreviated income statement to verify that the solution to part D will provide the desired after-tax income. Okay, so we should end up with $250,000 right here. So sales are let's see here, delete 744,277. Okay, and then what we also want to do here, let's make this a little bit smaller. We want to take this, remember our contribution margin ratio was 38%, but we can also see that we have variable costs of 62%, so we can actually take that 62% and multiply it by okay, so let's see here, 1081, I'm going to go 452 because I'm pretty sure that would be right. And then our contribution margin, we're just going to subtract this out. We're going to take the sales and subtract out all of our variable cost. $662,825. Okay. Our fixed cost, that was a number that was provided to us as being $266,000. So now we can get our net income before taxes because we've accounted for all of our variable and all of our fixed costs. So since I've already got this number on the calculator, what I'm going to do is I'm going to now subtract $266,000 from it. And that's going to give me a net income. What is it now? It's 396,825. Okay. Income taxes, all we have to do now, we can just use the 37%. So we're going to multiply that by 0.37. And let's see here. That's going to give us, I'm going to go with the, I kind of know what to do at this point because I'm almost to the end, 825, and I'm going to round down because remember we had to end up at exactly 250,000, and so let's see if we made it. 396,825 minus 146,825 equals 250,000, and that's what we were kind of hoping to get to in the first place. Okay, so now we can check the answers. I can't imagine, since I've already checked these four up here, I can't imagine that there would be anything wrong. Yep, all still right. So very good. That one can be somewhat troubling to students, mostly because of this D requirement here. After we get through that, everything else is more or less cream cheese. All right, thanks for watching the video.